Lesson 1. What is technical analysis? Well, consider looking at the chart of the S&P 500. In the long run, what do you think will happen? I'm sure most of you would say that we are in an upward trend, and if history is any indication of what will happen, in the future, the price will go up. Maybe not in so many words, but I'm sure that is the logical conclusion that you probably came to when you were talking with either your financial planner on whether or not you should invest, or looking at your 401k and deciding what options you are going to choose. And as someone who worked in financial advising in the past, I have had that exact conversation with many individuals. And if we based our decision on what we just discussed, we would have used a simple basis of technical analysis to start investing. And in this case, to start investing in the S&P 500. So then what is technical analysis? Well, technical analysis is the study of market action, specifically price action that occurs over time. The three basic principles of technical analysis are as follows. Number 1, market action discounts everything. So what does that actually mean? Market action discounts everything. Basically, what that's saying in a nutshell is that the price that it is right at this exact second is the price that all market participants can agree on, of a price worth buying or selling, and are voting with their dollars by either buying or selling or not doing anything at all. So, therefore, whatever happens in the marketplace is at that exact second the perfect price for whatever asset that is being traded. Number 2, prices move in trends. Trends when it comes to the stock market and financial securities is pretty much based on the logic that we went over in the beginning of this lesson. When we look at the S&P 500 and we see that it is on an uptrend, we tend to think that we should invest. Therefore, building on the trend is your friend mentality that many stock traders base their trading strategies on. Conversely, when the market is selling off, many people also will be selling off their positions to cut losses and, in turn, following the downtrend. Many of this is based on human behavior and psychology of the market, which, if any of you have seemed to forgot, the market and its participants are all humans and behave rather predictably when markets rise and, of course, when markets sell off. Number 3, history tends to repeat itself. Similarly to the trend and the upward trend of that S&P 500, history tends to repeat itself. We can see that in the long term this is true, but also as we dive deeper into the course, we'll find out that on many different time frames, you can find history repeating itself, also at different price levels, which we will call in the future support and resistance levels. And we'll see the trend try to keep its trend going based on historical prices and, of course, historical volumes. By studying price action over time and incorporating the 3 principles of technical analysis, one can further their understanding of financial markets, and by incorporating various charting tools and indicators, can generate short-term trading signals as well as long-term trading signals. Utilizing these basic principles, a technical analyst uses chart patterns, price trends, volume and momentum indicators, oscillators, moving averages, support and resistance levels to make entries and exits on his or her trades. Now, with all the different indicators, oscillators, and lines, how do we even begin to make sense of it all? Well, we need to start with the basics. And that's what we're going to start in the next lesson, lesson 2, when we talk about the chart.